Hi everyone, it's me again. Welcome back. So yesterday we already discussed about Article 12, which is Trading Strategy Overview. Today we're gonna keep reading the next article, Article 13. So what is Article 13? It's a market neutral strategy. So first one is about definition. Market neutral is a group of investment strategies undertaken by an investor who simultaneously opens long and short positions in order to minimize market risk on portfolio returns. It's useful when investors want to remove market volatility from portfolios return to focus on forecasting stock returns. This strategy has two main characteristics. Can yield profits regardless of whether the market rises or falls. Opened opposite directions simultaneously with equal market risk. In the stock market, investors often use beta from the capital assets pricing model CAPM as a measure of systematic risk. In this context, a market-neutral portfolio is defined as a portfolio with a beta of 0. Pairs trading is a simple and common form of market-neutral. The purpose of a pair trading strategy is to look for the stock pairs that have a highly correlated price history. When the price correlations of two stocks deviates from the long-term average, investors buy stocks that are underperforming while selling stocks that are outperforming. They expect that this deviation is temporary. When the price correlation of two stocks converges to the expected average, investors close position to realize profits. Next one, statistical arbitrage, StatR, is also a group of market-neutral strategies that evolve from the pair trading strategy. It uses mathematical and statistical models along with computer assistance to make the most of the trading opportunities. These opportunities come from abnormal changes in the relative price of one stock to another. In terms of classification, the statistical arbitrage strategy group includes pair trading. Pair trading can be considered a statistical arbitrage strategy. However, statistical arbitrage is not exactly pair trading. With the help of computers, statistical arbitrage strategies can combine buying or selling two portfolios with hundreds of different stocks. At that time, investors will select potential stocks and rank them according to relative valuation criteria. Then they buy relatively cheap stocks while selling relatively expensive stock. Examples of market-neutral strategies. Suppose the investor had just analyzed and selected a portfolio of 5 stocks in VN30 as follows: FPT, HPG, TCB, VIC, VPB, referred to as VN5. Investors predict in the future the VN5 portfolio will be better than the general market. As a benchmark, the general market is the VN30 index. They decide to invest 600 million Vietnam dong according to the market neutral strategy as follows. Buy 500 million Vietnam dong in VN5, deposit 100 million left to open 5 short positions simultaneously. Assume VN30F1M index is 1,000, margin is 20%, and VN30F1M price change entirely correlation with VN30 index score. Assume the VN5 portfolio has better performance than the general market. So if the market increases, VN5 increases more. And conversely, if the market falls, VN5 falls less, excluding fees and taxes. Assume two market scenarios with investment results as follow. That you can see in this picture, on the left side is bull market and right side is bear market. You can read and dig more by looking at this chart. If the market rises, VN30 increases. The short position on VN30 F1M incurs a loss. However, investors expect the VN5 portfolio to increase stronger than VN30, 12% versus 10%. The profits from VN5 portfolio offset the entire loss from the short position. The final profit is 10 million Vietnam dong. Conversely, if the market falls, the VN5 portfolio incurs losses. However, the investor expect VN5 to fall less than the market, say like minus 8% versus minus 10%. At the time, the profits from short position offsets the entire loss from VN5 portfolio. The final profit is also 10 million Vietnam dong. Next one, strengths of the market neutral strategy. As in the example above, with the market neutral strategy, investment results depends on primarily on selecting the right stock. Portfolio with better potential than the market average. It's not dependent on accurately forecasting short-term price movements. Using these strategies, investors only need to focus on researching, understanding, and choosing a good portfolio of stock with solid fundamentals. The portfolio should have high profit potential in long term, not worrying about short-term market fluctuations. Short-term events appear very random and difficult to predict properly. They can only be perceived when they have occurred, and there's no time to act at such moment. In addition, it saves a lot of time and effort from monitoring the market and daily fluctuations. So that is the end of Article 12. The first one, market neutral strategy. So we gonna read together and discuss more about the next strategy, which is price momentum, next time. See you.